Hello, Flagship Harbor Advisors. Happy New Year to anyone that I haven't had a chance to connect with yet. Eric Jefferson with the core team here, and appreciate the patience. Today's recording, very overdue. Following the Ed Day we had late last year, had a lot of different questions on the different portfolios, some of the mechanics of the platform. So, wanted to spend a couple minutes just walking through the lineup, some of the changes, highlight some of the resources, but then more importantly, share some thoughts with you around how and where not only this platform but the underlying strategies may fit in based upon types of clients that you're working with and problems that you're ultimately looking to solve. So I want to start just a quick overview of the team. You see the four of us here that work in conjunction, obviously with Jay, David, and Mark. You have Michael Sanchez, both my partner on the retail and the investment side. Him and myself do a majority of the work with respect to the investments. His discipline very much on the technical models, the TIM portfolios, does a lot of the option work as well. He leads all of the trading efforts. Megan Haugen and Darling Carl, they lead the logistics or the operations aspect of the platform, covering everything from advisor onboarding, setting up all the different move money, the systematics, the DCAs, as well as putting together several of the deliverables. And then myself focuses more on the fundamental portfolios, the tactical ETFs and SMAs, as well as ETF security selection that's included or emphasized in our strategic portfolio. I'll talk about it a little bit. And then lastly, putting together the commentaries. One piece that I just want to highlight here, the four of us, we all operate as a team. That was something we decided a while back when I joined, as opposed to having different strategies where certainly Michael and myself may run point on. At the end of the day, there is no priority. There is no difference in compensation or goals or initiatives with respect to which portfolio or combination thereof you may incorporate. Our goal at the end of the day is to create a platform where you see value to your business and your underlying clients, and then ultimately help you find and navigate, incorporate the portfolio that is the best fit, again, for what you are looking to accomplish. As we start here, have a quick lineup of the different strategies available. I'll go through these in just a moment, but as a quick reference, high level, here are the different portfolios that are available, some of the different inputs. So again, how they are created, what they're positioned. We touch here about holdings, time horizon, turnover, rebalancing frequency. We'll touch on cost, and then lastly, have a few changes to the pricing. That's something here just as a reference when we think about how we ultimately think about pricing these going forward. You'll find that pricing grid highlighted in the last column there. But starting with the most important pieces, going through the actual lineup itself, I'm going to quickly go through a vast majority of these, then spend a little more time on the three most popular portfolios. First, at a high level, are strategic low cost. These are globally globally diversified asset allocation portfolios that emphasized low cost investments. Here's where you see a lot of the spiders, a lot of the vanguards. Where you would think about incorporating this, again, these are for folks that are looking for low cost diversification, really people that are looking to outsource the operational work, the trading, rebalancing, and simply just emphasize low cost investments. The strategic lineup, that is also a globally diversified asset allocation portfolio. The difference being there is spend a lot of time on ETF due diligence. So meeting with different product sponsors, vetting the SWIN availability list. At the end of the day, trying to identify what is the best way, what is the best factor, what is the best theme or thematic overlay to gain exposure to that respective asset class. The benefit with a strategic portfolio, lower turnover on the surface. Those models had all of 2 trades last year. So we think about particularly your non-qualified accounts, folks that may be a little more tax sensitive. That's certainly one option to consider. The tactical portfolios, this is one we'll talk about in a little more detail. There's 3 components that come together when you think about the 3 different ways to generate excess returns. This portfolio has moderate degree of trading. Last year, I believe, in the ballpark of a dozen or so moves. So we'll certainly move around positioned for the short-term outlook, but will be slightly more tax efficient versus some of the more active strategies. Speaking of active, next up we have the technical portfolios, or the TIMS, the technical investment model. This is what is run by Michael, and how I best describe this: it is truly active. It is unique in the sense that there is virtually nothing else out there like it. We'll talk a little bit in more detail with respect to what it is, how it works, but this is a portfolio that is going to very, very aggressively position for the short term, whether that's going long or short, or even owning some fairly esoteric asset classes. That is based on price momentum, and again, identifying where are there short-term opportunities in markets. You see one of the recent enhancements to the platform. Midpoint of last year, we created 3 SMAs, or separately managed accounts. Those all own individual stocks, 3 offerings altogether: a equity income, a all cap, and then a large cap. Again, those have a conservative, aggressive, and then moderate risk profile to them. So for folks that like the idea of individual stocks, have 3 options available to incorporate. Again, this is something you can blend or have as a standalone investment in a singular account. We also have the ability to offer custom portfolios, something probably about a third of the advisors that leverage the platform utilize. This is where you give us your intellectual capital. We manage your portfolios on your behalf. In essence, you are hiring us to outsource all of the operational work, the trading, the rebalancing, as well to be able to give input on asset allocation and implementation, if that's something you're interested in our views on markets and positioning. And then lastly, we have the ultra conservative portfolio. This is a model that today yields north of 4%, and again, incorporated for folks looking for stability of principal. We've back tested this, and I think the worst drawdown this model experienced was about 1.2%. So again, designed to be very stable, generate in today's world at least a fairly attractive or fair degree of income. So I want to take a closer dive into 3 portfolios in particular. The first here, talked earlier, these strategic models. These are globally diversified asset allocation, but the emphasis or how these attempt to generate alpha is through security selection or implementation. As I mentioned, spend a lot of time doing research on different ETF offerings. And you'll see here a list of the equity and the bond holdings throughout the course of the year. In the far right-hand column, we have the excess return that they generated relative to their respective benchmarks. One point that I'll highlight there, on the equity side, the only position that underperformed the S&P 500 was the American Century US Quality Growth, but versus the Russell 1000 growth benchmark generated just north of 5% excess return. The bond market, you saw that be slightly more flat, but again, a good source of outperformance from the absolute return instrument we listed there at the top. Shifting gears, thinking about the tactical portfolios, the philosophy behind these. If you go out and you Google how to make money in capital markets, there's probably hundreds of thousands, if not millions, of different strategies, techniques that come up. The end of the day, as we all know, no one single strategy works best in every single market. If there was, there wouldn't be multiple ways to do it. And given all of these strategies, at the end of the day, really only 3 ways to generate excess return relative to a benchmark. The first is timing the risk on, risk off. Second is having the right factor or style allocation. Then lastly comes down to implementation or security selection. Again, owning an instrument with a similar risk profile as your benchmark, but one that has consistently and throughout various market cycles demonstrated the ability to generate excess return. And so when we think about the tactical portfolio, for those 3 ways to generate excess return, we've built 3 components that dictate the underlying allocations. We have the implementation sleeve that owns a lot of those names seen or held in these strategic portfolios. Again, those are ETFs that have, both in good markets and bad, demonstrated the ability to outperform. We have a handful of instruments that have internal quantitative risk on, risk off, rules-based metrics. A handful of those will follow the technical discipline that will, at the end of the day, risk on or risk off the underlying positioning within those instruments. Benefit of doing it within an ETF wrapper, where some of those portfolios will have a 700% turnover ratio. At the end of the day, rules are different for an ETF versus a mutual fund. In the eyes of the IRS, trades within an ETF wrapper are considered exchanges. In essence, that does not trigger a capital gain, which you are all but insured to receive in a mutual fund. Then lastly, we have a fundamental sleeve. And again, here's where we are going to emphasize things like value versus growth, high quality versus more speculative, high versus low beta, duration versus credit. Again, based upon the short-term fundamental outlook, we're going to position those portfolios based upon where we think there is the most opportunity for success. Moving on, last model I want to dive into a little more detail on is our technical portfolio. Again, this is a discipline run by Michael Sanchez. We have a screenshot here. This is from the DeMark indicators. That is the gold standard within technical analysis. This is a plugin to a Bloomberg terminal, something that is very, very rare in the financial advisor community, something he spends a great deal of resources to. And at the end of the day, what this allows, there's thousands of different metrics when we think about charts and patterns, volume, momentum. This system will highlight a select few that have very high probability indicators, and he will run a handful of instruments, meaning underlying tickers and indices, through these technical screens. At the end of the day, that will generate buy and sell signals, which ultimately then dictate how his portfolios are positioned. As you can see on this slide here, this strategy is truly active. Again, for clients that want portfolios that are going to move around, that are going to take advantage of short-term price momentum opportunities, this is the portfolio for you. And again, there are very, very few things like it. Over the course of 2022, I believe in total, there were just north of 20 trades. So again, give you some insight into how much this portfolio is turning over. Michael is very aggressive in implementing a specific view. When that position hits its price target, we'll likely then move on to that next trade. Again, we have a snapshot here just of those allocation shifts from January 1st of last year through August, about 20 trades in total. Now, one thing just to keep in mind, obviously for non-qualified accounts, high degree of turnover, so something just to be mindful of with respect to tax sensitivity. One of the questions that we get a lot is, where can we find all of the different resources? First and foremost is an email to either Darling, Michael, Meg, or myself. At the end of the day, we are designed to be a resource to you, an extension of your practice and your team. That being said, do organize a lot of the more common information right in Dropbox. That is something, if and when you enroll in the program, you will receive your own login, your own access to these folders. We include here updated bi-weekly performance reports that list every single model, how it's done relative to benchmarks over a trailing time series. We also have portfolio profiles. We have abridged versions, and then more in-depth client approved that will go through, look at asset allocation, look at holdings, look at performance, look at yield, expense ratios, etc. We'll do that at a high level with just the model allocations as well, represented within those folders there, highlighted in the red circle. And then lastly, I want to focus on the fun part, the cost of the platform. As you can see here, we have our previous pricing grid, if you will. When I first joined, the focus or the shift that we wanted to implement was rewarding advisors that used the platform via discounted core cost. And as such, we elected to price the platform being a function of the assets an advisor has in the portfolios. At the end of the day, how we ultimately price this, we will assign you a blended rate. That blended rate is then assessed to every single account that you have in the program, How we determine that blended rate, though, is a function of your total assets in the program. So we look through those horizontal lines. You think, right, what are the total dollar amounts I have? And then you'll see in the middle and far right column what the respective price for standard or the traditional ETF models is, as well as the premium models. That includes SMAs and structured notes. And then as the end of the day, each quarter, we will go in, look at accounts that you have, ultimately, what price level do they fall in, and then simply create a blended rate. That blended rate is revenue neutral to your client, to you, to Flagship and the core team. It's just a way to more simply, more efficiently bill the platform. But again, how we price that blended rate, truly just a function of the underlying strategies that you are incorporating. Few final pieces to highlight here. Again, this core cost, this covers any and all ticket costs. So no trading expense. What the number that you were assigned via that blended rate is ultimately at the end of the day the only cost that will impact you. We also offer rights of accumulation. So if this is something interested in the program, recognize probably not going to get to 12 million overnight. That's something if you tell us within a 3-month window, this is my target, we will give you the benefit of that accelerated discount, price you from day one in that respective tier. And then finally, something only a few folks have taken us up on, but if this is something you want to try the program for yourself, let us know. We have the ability to offer your personal accounts managed at no cost. So again, if that's of interest, please let us know. That's all for now. If you have any questions, comments, feedback, or suggestions, anything that we did not cover in this call, this recording today, please don't hesitate to pass them on. And as always, we stand here looking to be a partner. Please let us know how we can help. Take care.